From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for June 20th, 2025. Let's check the calendar. Of course, we'll start off with the first weekend of Summerfest and James Taylor headlines Saturday night. There's music in Oak Creek. It's the Summer Solstice Music Fest, and here's an event that's new to me. Vegan Mania at Greenfield Park on Sunday. No songs by Meatloaf are allowed. And our Brewers welcome the Minnesota Twins to town for a 3-game set this weekend. And our Landis tip of the week for this hot weekend is drink plenty of water. A woman wanted to make a TikTok video about the interaction between humans and wildlife. She posted the video of her feeding a cute, cuddly little beaver. Her TikTok friends quickly pointed out she was actually hand-feeding a sewer rat. A Wyoming college student told police officers she was working on a term paper on kleptomania. That was her excuse after she was arrested for shoplifting $1,900 worth of stuff from Walmart. I don't suppose she's taking a course in criminology. And finally, checked out this ad in Forbes magazine. DoorDash launches cannabis home delivery. What? No anxiety, no fear, no lying to the cops. You're just holding it for a friend? Nope. Just call DoorDash and they'll deliver it. I've lived a long time. Right, on the podcast today we have Steve Giles, John Sandstrom, Joel Driesing, and wrapping up the week, here's Kyle Tetting.
Well, thanks, Max. A fairly flat week overall. The NASDAQ up 0.2%, closing at 19,447. The S&P 500 in a 4-day trading week down 0.2%. That's 9 points on the week, closing at 59.68. And the Dow Jones Industrial Average basically flat, up 9 points on the week to close at 42,207 on Friday for the year. NASDAQ up 1.0%, including dividends. The S&P up 2.1%, and the Dow clawing back to positive when you factor in dividends, up 0.1%. It's a quick look at the week. Steve, the kind of big news this week was the Federal Reserve meeting Tuesday, Wednesday. We've had a lot of conversation about will they, won't they cut rates, should they, shouldn't they cut rates, but really we haven't learned much new beyond the many, many things that are still uncertain. And so we got more or less no action from the Fed on Wednesday, some updated economic projections, some forecasts as far as maybe what they expect going forward, but at least from a kind of high-level perspective, not much new from the Fed this week.
No, not much new at all. And Joel, I don't want to steal your thunder when we get to the economic indicators, but I think the Fed can point to some of what we saw this week as reasons why they decided to stand pat, although they did suggest that they're still inclined or a couple of rate cuts are still certainly on the table, data depending, before the end of the year. And what it does for us as investors, Kyle, is it really brings back into the fold the question we always get: what's a better deal right now? Should we invest in stocks or should we invest in bonds? And when you look at where the 10-year Treasury ended, about 4.4, and you look at where that earnings yield is on the 12-month forward earnings numbers at 4.5, it's just about a coin flip, and I think argues for continued balance in investor portfolios.
You know, John, as we kind of look at some of the Fed's projections and look at, this idea that maybe we get those 2 rate cuts, you and I were talking earlier about this idea of neutral interest rate and the fact that even with a couple of cuts, the Fed would probably remain fairly restrictive. Of course, the challenge I think the Fed faces as we see kind of the constant economic reporting is that all of this is a moving target. And there is, I think, quite a bit of uncertainty out there, which maybe also speaks to a little bit of what Steve was talking about of maybe the right play right now is to make sure that you've got the game plan, to make sure that you have some conservatism in your portfolio. How are you kind of navigating some of that conversation with clients right now?
I mean, I think it's consistent messaging with what we've been saying, towards the end of last year and the entire year this year. there's a reason why we invest the way that we invest, and balance is definitely key. And it goes to show, speaking on the Fed and cutting and that line of thinking, it's their projections for inflation at the end of the year seem to be maybe potentially a little bit higher based on some of the stuff that's going on in the grander economic landscape. But unemployment they don't see moving too much. So it's kind of interesting to see, potentially 2 more rate cuts, as you said, by the end of the year. Obviously, that's still in a restrictive state, but based off of the data right now, it makes sense that they would stand pat and not cut anything. Inflation kind of where it is, but they don't necessarily know exactly where it's going, and unemployment still in a good spot. It makes sense to stay where they are.
John, I'm totally content having rates stand pat right now with the amount of money, or pardon me, the yield we're getting on fixed income investments. And for those investors who can think back to the 90s and early 2000s when you got interest-bearing checking accounts, 5-6%, for the amount of money that we have in fixed income and portfolios, knowing that you're getting something for that money is comforting.
Well, that and another thing Kyle and I were talking about is, with all the uncertainty and with rates being where they're at, talk to us about what your cash needs are in the short term, because with rates being where they're at, you could park money that you need, save it from being in all of that uncertainty, and you're still getting a decent rate.
I think the 2 encouraging things, first, the one that you 2 hit on so clearly, is that, yeah, I love the idea that we actually are getting paid for safer money. But the second is that if we think about what the Fed's responsibility is, the Fed's dual mandate, the Fed's mandate is not to do what politicians tell them to do. The Fed's mandate is to look at the data, look at the labor market, and look at the price stability portion of the mandate, and to make determinations about what to do with rates based on that data. And to me, that's what the Fed is doing. Yeah, there is some expectation that if they fail to act and the economy does cool a little quicker than what they're otherwise thinking, that maybe they'll be behind the curve a little bit. But I think based on what we can see right now and based on the way they see things shaping up, well, they're still doing the things that they're supposed to be doing based on that mandate. And Joel, looking at that economic data this week, some signs that we've been talking about slowing, we've been talking about some less than encouraging data over the last couple of months. More of that this week, particularly as we look at things like the retail sales number out early this week. Yeah, consumers still showing that they're fickle.
Yeah, right. Thanks for stealing my thunder, Steve. It's interesting because all the numbers that we got this week, I kind of wrote this in the side margins before the podcast, is things are all looking weaker, but they're at a point where they're not
weaker,
really
W-E-A-K or
yes,
W-E-E-K?
E-A-K-E-R, yes.
Okay, all right.
They're not as strong, and yet they're not really weak when you look at the bigger picture. For instance, we have the leading economic indicators came out today from the Conference Board, and although they're down and they're looking weaker, the Conference Board isn't yet seeing a recession. It slowed down from April as far as even looking at the longer term, the 6-month movement, and it's negative. It's more negative than it was in April, but it's still not recessionary. We had housing numbers on Wednesday, looking at housing starts and building permits, and so those housing construction numbers all were at levels that they're the lowest that we've seen since the pandemic recession, which sounds bad, but back before the pandemic started, we were at the highest place that we had been since the Great Recession. So even though things are bad, compared to in the last couple of years, they're still not as bad as they were before. The one that you pointed out is retail sales, and that bears more watching. We've got 2 months in a row where the retail sales numbers are lower. That is 2/3. That represents 2/3 of all of consumer spending in our country, and we know that consumer spending represents like 70% of our gross domestic product. So 2 months down on retail spending doesn't bode well. And one of the things that I look at in there is spending at bars and restaurants, and that's down. And I usually think that, you know, if things are going okay and people are feeling all right, they're going to be spending more at bars and restaurants, and that's down. But again, it's sort of at a cautionary level. It's not at a point where maybe the Fed has to worry much and start stimulating the economy with lower interest rates.
We might think that maybe the relationship between bar spending and restaurant spending might be a little bit inverse, and that the better you feel, maybe the more you spend in restaurants, the worse you feel, maybe the more you spend in bars. But I think you need the cash in order to be able to do that spending.
That's liquor stores.
Fair enough.
The liquor store indicator.
Fair enough. You know, I think a lot of this data is always rear-looking, right? It's always, here's what we've come through, and we did get a piece from the Conference Board this week on leading economic indicators, pointing to, yeah, okay, things are not great, and a lot of the stuff we've been talking about is also what we see maybe looking ahead. And yet that survey pointed out that GDP growth is expected to still be meaningfully positive.
Yes, yeah. So, it's interesting because it's a leading economic indicators is what the index is called, but it's all looking at things that have happened in the past to come up with that. But yeah, you're right. They're saying, and they're doing this for the second month in a row now, where they're seeing a forecast of 1.6% growth in gross domestic product for the United States in 2025. They're seeing it slow down more than that in 2026. Just to compare, in 2024 it was 2.8% GDP growth. As recently as February, the same Conference Board, using that same index, predicted that 2025 would have a growth rate of 2.5%. So within a couple of months, they've gone from 2.5% growth for the economy down to 1.6%.
You know, I think it's such an important reminder that for all that we can try to forecast and predict and project, whether it's the Fed, whether it's economists, whether it's just us sitting around the table, there is so much uncertainty right now out there that is going to weigh pretty heavily on this, not the least of which, John, is this Israel-Iran conflict that seems to have inflamed a little more again this week. I think as we kind of look at our portfolios, you know, you and I were talking earlier today about how we've, for the better part of the last year and a half, been trying to take some risk off the table. And it wasn't because we knew, hey, there's something bad that's going to happen. There's always bad stuff out there that can happen. But it was more about the fact that we were getting great prices to sell stocks, and there were some new things cropping up that made us a little nervous. I look back to those changes that I made a year ago and coming back around now to kind of the one-year review on those clients. Well, all of a sudden, their stock allocation looks higher again than where we had set it maybe a year, 6 months ago, because stocks have done well. And so maybe a reminder for clients that in a market in which the stock market has done fairly well, revisiting those allocations makes sense right now, revisiting that plan.
Yeah, and just as you said, 2-3% stocks have moved up since the last time we made those reallocations last year. But in times of uncertainty like this, I mean, you can't predict wars are going to happen, and you can't predict, you know, policies that are going to go into place or stuff that goes haywire across the globe. But one thing that you can go back to in these times that helps us kind of look at these things is fundamentals. And I think that if you do look at the fundamentals, you still can see, you know, stocks are expensive and certain sectors are expensive, and always look at that stuff in comparison to where you're allocated, and then talk to us and we can get you, you know, allocated back to where you need to be.
And I think it's tempting to want to try to predict where is this headed, what's going to come from this. I think if anything, the range of forecasts I've seen for something as simple as what's oil prices going to look like 2 weeks from now, a year from now. Well, anywhere from, a few dollars more if we get into a prolonged conflict to pushing back to $115, $120, $125 a barrel, which is considerably higher than where we are now. I think that tells you everything you need to know about how much uncertainty there is around these kinds of conflicts and how you have to be prepared, because just as quick as they can start up, I think we can also see some resolution, and you could potentially see, well, okay, we're on the other side of something now, and let's see what comes next. I think entering a weekend after a 4-day week in which there is plenty to be paying attention to, tariff conversations, tax policy, spending bills, wars between Russia, Ukraine, Israel, Iran. There is no shortage of things, I think, that are going to keep us up. But, again, I think the reminder here that balance is the part that helps us navigate that uncertainty. The important piece to remember that we are holding stocks and things in our portfolio that are exposed to risk, not for what they do tomorrow, but for what they're going to do 5 or 10 years from now. And that it is that 4.4% yield on the 10-year Treasury and related type investments, I think, that gives us some confidence to get through this bit of uncertainty. With that, we enjoy doing the program for you. We'll talk to you again next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.